Welcome back to Investing Talk Podcast.
Today, we're looking at Canopy growth.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis.
Right.
For Canopy growth, we're looking at a company that has spent years, really, in the financial wilderness, just undergoing this painful contraction and massive restructuring.
Oh, absolutely. For so long, the story wasn't about growth. It was just about survival.
Exactly. But what we're seeing now, and this is the single most important thing to understand, is a fundamental shift in that narrative.
An inflection point.
Yes. We are moving from deep stabilization, which was kind of the theme of last year, into a new phase, actual measurable growth in the core business.
And you can see that in the financials, right? The clearest evidence is the return to top-line growth.
For sure. In the second quarter of their 2026 fiscal year, consolidated net revenue actually rose 6% year over year.
Which brought it to $67 million.
Now, that 6% is good, but here's where it gets really interesting, and it shows, management's discipline.
Right.
If you just isolate the core business, the actual cannabis net revenue, that number was up an impressive 12% year over year.
Landing at $51 million.
Right. And when you're shedding all these unprofitable assets, but still seeing double-digit growth in your main product line, it shows the cuts were surgical, not just blind contraction.
It's quality over quantity. And I think the next layer is to look at where that growth is coming from.
Exactly, because if it were just low-margin flower, it wouldn't really move the needle on profits.
But it's not. The strategic anchor here is the higher margin medical segment.
Precisely. The Canadian medical cannabis net revenue grew a powerful 17% year over year in that quarter,
Reaching $22 million. And we should probably pause on why that's so critical.
Yeah, we should. Medical cannabis is just a different beast than recreational.
It's stickier.
Much stickier. You have less sensitivity to price wars, higher product quality, and it can even be covered by insurance in some places. It's a much more stable, high-margin foundation that, frankly, this company desperately needed.
And while medical is the anchor, you can't ignore what they're doing in the broader market either.
Oh, no. Canadian adult use revenue still grew 30% year over year in that same Q2 period.
So you have that combination of high growth in adult use and that really high margin growth in medical. That's the engine.
Which naturally brings us to profitability, because growth without better margins is meaningless.
Right.
The proof is in the gross margin expansion. Consolidated gross margins hit 30% for the full fiscal year 2025. That's up 300 basis points year over year.
And for anyone not familiar, 300 basis points is a 3% gain.
Yeah.
That is a substantial jump in operating efficiency, especially in this sector.
And it didn't stop there. By the second quarter, they'd reached 33% gross margins.
So that sequential jump from 30 to 33 shows that operating leverage is starting to kick in. They're making more profit on every dollar of sales.
Which is the prerequisite for hitting that holy grail break even. And the progress here has been dramatic.
It's dramatic, are we talking?
Well, the adjusted EBITDA loss, it narrowed by 60% year over year in FY 2025. But the most recent quarter, Q2 FY 2026, that loss narrowed to a stunning $3 million.
Just $3 million. That's basically noise for a company of this scale. You are one good week away from reporting positive adjusted EBITDA.
It completely changes the conversation. It's not, will they run out of cash anymore? It's, when do they hit sustainable profitability?
And the operating loss from continuing operations improved 63% in that quarter, too. It all points to just relentless cost discipline.
And that cost control, plus some really aggressive balance sheet management, has basically resolved that fundamental survival risk.
The going concern doubts.
Those are gone. Management addressed it by deleveraging. Total debt was cut by nearly half, a 49% reduction.
Dropping from $597 million down to $304 million. That's huge.
It is, because it structurally lowers their interest payments. That frees up cash.
And their liquidity profile now looks incredibly strong. As of September 2025, their cash actually exceeded their debt by about $70 million.
Right. And if you look at the current ratio, a key liquidity metric, it stands at a really robust 5.5.
A 5.5 current ratio is fantastic. A ratio of 1.0 means you have just enough to cover your bills for the next year. 5.5 means you have $5.50 for every $1 of liability.
It removes any near-term liquidity concerns. It builds that fortress balance sheet everyone wants to see.
Okay, but hang on. A fortress, can we really call it that just yet?
What do you mean? The numbers are there.
The liquidity is, but we have to talk about the big hole in the argument. Free cash flow. It's still deeply negative. That's a critical point.
It was negative $176.5 million in FY 2025. So isn't this fortress relying a lot on asset sales and this massive regulatory tailwind that hasn't actually happened yet?
That is the perfect way to frame the risk, which we'll get to. But the strength of their current position allows them to do something they couldn't before. Play offense.
And that offense is all about building their competitive moat.
Which is really about positioning for the U.S. market, isn't it?
Totally. It's built on a couple of layers. First, their scale in Canada, especially medical, which gets a boost from the MTL acquisition. But the real strategic piece, the differentiator, is the Canopy USA ecosystem.
Let's slow down here because this is where it gets a little complicated, but it's super important.
It is.
The U.S. market is fragmented because of federal prohibition. So how does this Canopy USA structure actually work to give them a first-mover advantage?
It's a very sophisticated workaround. They've set up a separate U.S. holding company, Canopy USA, which holds conditional ownership of U.S. operators, like Acreage Holdings.
Conditional ownership.
Right, through things like non-voting shares or warrants. This keeps a wall between the U.S. assets and the Canadian parent, so Canopy can stay listed on the major exchanges. But it positions them to immediately consolidate these U.S. assets the second federal policy changes.
So they're basically sitting on a prepackaged M&A vehicle, ready to flip the switch the moment Washington gives the green light.
Exactly. The deals are already done, just pending that regulatory trigger. And that forward planning is why the stock is moving now, even before the fundamentals are perfect.
Which leads us right into the technicals, because the stock isn't trading on fundamentals alone. It's trading on policy.
Oh, absolutely. The price action is all about macro news. We've seen these incredible, decisive move shares spiking 54% in one day.
And another 31.86% intraday surge. That's not normal behavior for a company that's still technically losing money.
It tells you you're in a speculative binary event environment. And the central catalyst here is the U.S. federal reclassification of marijuana.
Moving cannabis from Schedule 1, the same as heroin, down to Schedule 3, with things like Tylenol, with codeine.
And for the industry, this isn't just a political win. It is a monumental financial game changer.
Because of one thing. IRS tax code 280E. We should really explain what that is.
We have to. Right now, under 200E, cannabis companies can't deduct normal business expenses, rent, salaries, marketing from their federal taxes.
So they pay tax on their gross profit, not their net profit. It's debilitating. It turns profitable companies into money losers.
But if cannabis moves to Schedule 3, 280E goes away overnight.
And it's just a federal administrative decision. It would immediately improve the economics for every single U.S. operator.
And since Canopy is structurally ready with Canopy USA, they could be among the first big players to capitalize on that new reality.
From a technical analysis view, those sharp surges we mentioned, they signal a clear breakout pattern, a regime shift.
For sure, investors are clearly accumulating shares in anticipation.
And when you get a rally of that size, it can set you up for a very bullish technical signal, the golden cross.
Right. That's when the shorter-term 50-day moving average crosses above the longer-term 200-day.
It's a classic signal that institutional money might be flowing back into a name that was previously, toxic. It suggests long-term momentum is shifting.
And if you're looking for tactical plays, this is all tied to a very busy calendar over the next, say, 1 to 3 months.
Okay, what's on deck?
First up is the Q3 earnings report, expected in early February 2026. The analyst consensus is for a loss of just -3 cents per share.
A 3-cent loss. That would be a staggering 96% year-over-year improvement.
If they hit or beat that, it could be the final operational push they need to tip into positive adjusted EBITDA.
And what's the second event?
The completion of the MTL acquisition, expected around the end of February. That solidifies their Canadian medical position and should bring some key cost synergies.
So you have this confluence of events operational catalysts and the macro policy catalyst, all happening in a short time frame.
Which creates a scenario with very high potential reward. But we have to temper that. We have to look at the bear case.
Absolutely. The risks are very real.
And the biggest risk, hands down, is regulatory delay. The whole bull case is basically priced on this rescheduling happening soon.
But the White House has said no final decision has been made. The timing is completely uncertain.
It's a complex process. If that policy shift gets delayed or diluted or blocked, The recent run-up could deflate just as quickly.
All those traders who jumped in on the 54% spike would be left holding the bag.
And we also have to go back to those fundamental profit concerns you raised earlier. The turnaround isn't complete.
Right. The EBITDA loss is almost gone, but they are still burning cash. That negative $176.5 million in free cash flow is a big number.
And the trailing profit margins on a GAAP basis are still, horrendous, around negative 146%.
That FCF deficit is the Achilles heel. If revenue stalls for any reason, they will eventually have to raise capital again.
Which means equity issuance, which means dilution for current shareholders. It undermines the whole story.
And there are still some lingering issues from the past to watch, too.
You mean the class action lawsuits?
Exactly. There are ongoing securities lawsuits alleging misrepresentation about costs for things like their pre-rolled joints and the Storz and Bickel devices.
And while management has fixed the operational issues, an adverse outcome in court could mean a big financial settlement.
Which would eat into that fortress cash balance we were just talking about. It's a reminder that they're still cleaning up old messes.
But again, you have to balance these risks against the progress.
That's the key.
FCF is negative, yes, but the operational losses are negligible now, and they've structurally de-risked the company by cutting debt in half. They have time, thanks to that 5.5 current ratio, to weather a policy delay.
So we've covered the operational turnaround, the catalysts, and the risks. What's the final takeaway here?
I think you have to see this not as a typical investment, but as a trade on two interlocking factors, policy and profitability.
Right. You've got the operational side delivering tangible results, 33% gross margins, debt cut in half. That provides a fundamental floor. The company is just less risky than it was a year ago.
And that operational base is what lets them leverage their unique strategic advantage, which is that Canopy USA ecosystem.
Makes them a differentiated play on U.S. normalization.
Exactly. If that Schedule 3 reclassification happens, the target is a 12 to 24-month re-rating of the stock as they consolidate the U.S. assets and that tax burden disappears.
And for tactical traders, the play is shorter term, right around the February earnings, and any policy news out of Washington. But for a long-term holder, it's arguably one of the most exciting high-upside plays on the financial rationalization of the entire U.S. cannabis sector.
It's a really compelling case. You have a company that's proven it can execute a difficult turnaround while it waits for the political climate to finally catch up.
If you found this analysis helpful, the question you should be mulling over is this. If the elimination of 280E could turn this company instantly profitable, what does that mean for the valuations of all the other U.S. multi-state operators who don't have a prepackaged consolidation vehicle? Think about that and make sure to hit that subscribe button before our next analysis.